The S&P 500 now has 4 live bullish patterns in play at the same time, which is very rare. We're going to be looking at all of them, including our biggest target to date, and compare it to one in recent history that worked out very well. We'll look at trend and a host of other things to give us an idea if not only the S&P can get back to new highs, but blast through those points and move even higher over the next few months. So let's start with the pattern work, and we'll start with the smallest bullish pattern we have so far. And this was the one, recall, we've been looking at on the 2-hour chart here. This was a breakout that occurred on June 3rd, and it was the third small bullish pattern that we've seen over the last number of weeks. You can see the previous one that occurred in the middle of May, which easily hit its target soon thereafter. This one hasn't quite gotten there yet, so it's been frustrating at times. As we know, the S&P has slowed down a bit as June has progressed. But most importantly, so far, as we can tell, the breakout zone has not been completely violated. It has been tested numerous times right away in the first few days after breaking out, then failing to extend too much above 60.50 over the last week and a half, tested it twice, including Friday, June 20th and Monday, June 23rd. Now, you recall what's happened over that time frame is extremely important, because coming into last week, we know we still had to deal with the Middle East conflict before it got extreme over this past weekend. Understanding all that, there were plenty of reasons to believe that this very small breakout could have been violated or at least tested. So it was tested again on Friday and on Monday and held both times. So what does it tell us? It tells us that, number one, news that seemed extreme and extremely negative couldn't affect investors' mood, and that even the smallest dips were being bought. Right, and considering how far we've come in a very short amount of time, getting back to new highs, and the VIX now back to levels we've seen in mid-February as well, there were plenty of reasons, geopolitical, volatility-based, and simply being stretched to expect a bigger drawdown, which of course has yet to happen. So if even the smallest bullish patterns in the shortest time frame are not negated, that tells us all we need to know about the mood of the market right now, right? It is literally climbing a wall of worry as all these days go by. And so after that comes 61.25, of course, very close by, but much more significant, because this was the first bullish pattern that we used the April low to measure from. So very clear now, and even though it was only a few weeks old, it's a substantial pattern, as we can tell, with a breakout above the 5,500-ish area, giving us a 61.25 target. And this one as well was tested right away, actually undercut it by a few days, but never closed below that key level, which now the S&P is extended from, and currently now between 10 and 11% above that breakout zone. So that just gives us a big cushion. And the bigger the cushion, the more that the S&P in the market can back and fill if and when it needs to, anytime we get too far extended as we go forward from there. We know that's going to come at some point. So as that continued, we can tell that this area here was then broken out from, and that produced the 65.55 target as well. And so the same premise, the market continues higher. This one wasn't even tested, as we can tell, because it had that gap up on May 12th, and they continued higher, holding near that gap as well, and now edging higher to new all-time highs. And what's most interesting about this is that, as we can tell, the volatility from a intraday basis, as we measure it, has obviously shrunk. But the news headlines have not gotten any better, so to speak. But what has gotten better is that the price action has shown us that the response to the news has been extremely strong and bullish, and we really have to respect that until it changes, because the onus is on the bears at any point at this time to leverage something that seems negative, turn it into obviously some sort of negative reversal. More importantly, have it form a bearish pattern that is then leveraged, right? All of that has not happened since the April lows, and it's a simple concept, but one we shouldn't really think too much about or look into as to when it is going to reverse. It will reverse at some point, but believing or acting as if it should and ignoring all the bullish action that we've seen up to that point, of course, would have been the wrong course of action. So at the time, again, May 12th, that was a big bullish pattern. But there is another one in play as well, which we'll talk about now, and that produced a target of 67.45. So here that is, right? So all we're doing is moving up the breakout zone to around right below 5,800, right? So we had that gap higher above it on May 12th to produce that. And so we didn't talk about it really until recently, just because we've had 3 other bullish patterns in play, and it has the same breakout day or zone, of course, as the previous one. And so even though this one's a good deal higher, we knew a lot would have to occur for that to stay in play. But now, a month or so past it, you can see that the extension is there. So we can look at this and understand that this one remains in play, and it has a little more of a cushion to work with as well. And so the way it goes is, as of last night's close, the S&P was 12% away from the target. At this breakout zone, it was 16% above. So let's break that down. Now, we know that's a big move. And I think it's very difficult for many investors to grasp for one simple reason. We haven't been close to those levels ever before, right? I mean, not only talking about getting back to new highs right around 61.30 or so, talking about going 400 points above that. So that's a big move. But let's not forget, the move to get to even this point was about 18 or 19%. So we've already had a strong move. And remember, on the way down March and then in the early stages of April, 16% was something we saw over the course of a few days back and forth. So we're removed from that volatility. So once we are, it then becomes, a challenge to believe we can see an advance that much higher than the previous high, right? Just in human nature. But that's still in play. So altogether, again, here are the 4 bullish patterns. Again, we're getting closer to the ones that are near 61.20, 61.25, and of course, edging closer to the much higher targets. But as we see all the time, the most important column of this pattern grid that we follow is the percentages above the breakout zone. So of the bigger ones, between 4 and 9%, once more, it gives the ability for the S&P to back and fill much more than it has up to this point, and have the majority, if not all of them, remain in play. So getting back to the biggest pattern, the question is, how can that target actually be achieved? So we don't have to go too much back in the past to remember the last time that a big upside target was finally acquired. That's, of course, S&P 6100. Let's go back to January 2024. Right? We know that the market had come roaring back from the October 2022 low. Had to endure some volatility along the way, but doing so finally got us back to that 4,800 area, which ended up being a 37% move from the low. So extremely strong advance just to get back up here. And of course, anytime that happens, it seems like a potential shorting opportunity. Talking about a near 40% advance, relatively short amount of time. And of course, the bears will always say that there's no way we're going to get through that. Look what happened after the internet bubble. We came all the way back, got marginally above that previous high in 2007, and then what occurred after that, the great financial crisis. So it's an easy comparison to make, an extreme one, but a simple one to understand. So not only that, an eventual move to 6,100 would have been a near 30% additional advance. Again, a smaller move just because the denominator we're measuring it from is higher, but still 30% after a 40% move, with that 30% being above the prior high. That was a substantial one to digest. And again, not many people thought it was possible. So as we know, 11 months later, 6,100 target was hit. Seems easy enough now, but of course it wasn't at the time, because every dip looked at a time when the market was going to roll over completely once more, which of course it didn't. But as we talked about then, and as we'll repeat right now, what needed to happen to eventually get that target achieved? We needed to see smaller bullish formations play out over and over again. And as we know, that is exactly what happened. There were 10 in a row, 10 straight bullish patterns form, 10 straight clean breakouts, 10 straight bullish pattern targets achieved, which eventually got us to 6,100. So in reality, this is what happened after the breakout, right? Right around 4,800, right in January, initial breakout held. There was some volatility along the way, but as the market extended, again, as we just talked about, that cushion grew, which allowed the March to April pullback to occur and not wreck anything. That allowed the even stronger correction from July to the early stages of August to happen and still keep that 6,100 target. So once more, this is what played out to have this target achieved. The same thing applies now to eventually get to 67.45 or beyond. What do we need to have happen? Small bullish patterns play out, and that's going to be key going forward. So even though we have a very lofty target now in front of us, again, now about 11% away at this point, there could be an even bigger one because we haven't gone back to new highs just yet. And if we do, or look for something like this to occur, if in fact the market is going to be moving higher, we may have some digestion if and when we get back up to the last high in February. If we do, wouldn't be surprised at all to see a lot more back and forth movement, say, over the next few weeks, few months, who knows. But if we do see something like this, we can measure it, right? This is a 27% advance from the intraday low in April to the last high. So a measured move would give us a 21% gain above that. And 21% above the last high would give us a target near 7,400, right? And so if we can't accept 64.75, then there's no way we can comprehend getting to 7,400. Of course, we're not saying that's going to happen, but if this type of cadence continues and we continuously see smaller digestive phases resolve to the upside more often than not, then of course that is a possibility as well. And so in terms of trend, one of the indicators we've been using a lot more and talking about, of course, is the go, no-go charts. And I think this is very important to, again, have this complement the pattern work to give us an idea if there's some support or, of course, if there is going to be any divergences along the way. So in terms of that, as we can tell, the trend on a daily basis turned to bullish right at the beginning stages of May. Remember, this is the May 12th breakout. So right when we had the breakouts that we just talked about, this is when the trend changed as well. So we're talking about, whatever factors the system uses, most likely momentum indicators, moving averages, and a bunch of other things, but it's showing as well that all that has turned now, and it could be supportive of these breakouts going forward. On a weekly basis, it took much longer. And so finally, this is last week, finally got to go, meaning that it went from neutral to positive. Now, if we look more closely at this chart, we can tell the last two times this occurred, we got different results. So the last time we got a change from, say, neutral to go was in the middle of March. So that ended up being a head fake, obviously. This was that bear market rally or that mean reverting move was turned into a bearish flag pattern. Of course, the tariff tantrum completely unraveled at that point. So everything just got negated right there. We were also eyeing a small bullish pattern that never played out as well. But before that, this was after the correction from October 2023, where the low here was nailed and we got obviously the move much higher, which lasted for about 2 years. But why don't I go even further back? Let's look at the biggest bear markets and pivots along the way, going all the way back to 2007. As we can tell here, a lot of back and forth movement, a lot of whipsaws right around the 2007 high into 2008. And of course, finally, when everything turned lower, this remained negative all the way until, say, the summertime of 2009. So after the low by a good amount, what did it do? It caught a lot of this move after that. And once more, we were talking about at the time, this was a major bullish pattern breakout at the same time. So we got the trend change at the same time as a bullish breakout, and that's when bullish patterns starting to work once more. So we go on to 2010. This was the volatility in the middle of the year, finally got released. Again, another bullish pattern breakout, another extension higher. That brings us to 2011. So we know that the August volatility began. The low was in October, but volatility remained with us. You can talk about all the 1% moves there until the early stages of 2012. And by the time we get another bullish pattern breakout and near the highs, the trend changed to strong or bullish once more. And we can tell how long that lasted, all the way through 2013, 2014 into 2015. This is the middle of 2015 now. This again was a summer volatility, which lasted all the way until February 2016. So soon thereafter, the trend changed to go once more, staying that way until the volatility that we saw in 2018. This was 2018, the fourth quarter debacle here, came back up again, did not hit the low, but in the early stages of 2019 finally changed, which then led all the way to the rally right before COVID. And after the COVID low, going back up again by the summer months or so, summer to autumn, finally changed to go once more, again, missing this massive rally, but nailing the meat of the advance all the way until 2021. So as you can tell, this rhymes with what we look at. We look at bullish patterns starting to work, and at that point, seeing volatility start to lessen, and that is, those are key ingredients to consistent uptrends then taking over. So once more, this is where we're at on the weekly chart. Could this be now the beginning stages of the next phase, getting back above previous highs and seeing volatility become even less as we go forward in the middle of what a lot of people are calling World War III? It doesn't seem like it, but if sometimes we have to put blinders on and look at this price action for what it is, because what did we just look at? We looked at all the previous markets going back to 2008, 2009. Plenty of negative headlines all those times, but all we can care about is how the market reacts to it. So we can also look at this in terms of trading boxes. And right now, it looks like we're breaking out of the fourth trading box. So we're having trading box breakout as opposed to breakdown, which is important because, of course, coming back from the breakdown from early 2025, it's a big difference. And let's not forget how consistent this was as well, going all the way back to March 2023 here, all the way up, a few boxes, breakouts until the pullback. And it was even more evident after the October 2023 low. Each one of these consolidation phases was resolved to the upside with little or more pullbacks along the way until that March to April pullback as well. And even coming into July, a quick glimpse just shows a lot more blue than red, which of course is bullish in our eyes. In terms of the MACD sell signals, right, they're just not working out. Surprise, surprise. When the market comes back that strongly, we saw it here too, most of the time when you see a MACD sell signal like that, it just shows that things are slowing down, not to the point where we're going to roll over though. And again, you don't know it until it happens, but so far, after getting the major sell signal in February, the first one that occurred was after the MACD, which was historically extreme based on the huge comeback in the price level of the S&P 500. The rollover in the indicator didn't do much at all, with the S&P continuing higher. And now we can tell with the lines staying very close to each other, the first time that the faster line undercut the slower one was, again, just a week and a half ago or so. And so far that has been voided too. So this is something we'll always look at, because eventually we'll see bullish patterns fail. We'll see momentum start to fade, and that could then result in a sell signal that works, which we'll have to pay attention to. And lastly, all of this has been made possible just because of the low two-way volatility. And this is the up-to-date table through June 23rd, and so far had just 1% decline in June after one in May. And let's not forget too, in April, all of these 1% gains happened after the low. So it was only about 2 or 3 since that point. So the count has been in extreme favor of more 1% gains than losses, right? And that's a huge part of this entire story. So as of right now, we have 21% gains, potentially 21, depending on how Tuesday ends up playing out. That's right about even, and of course now higher for the year. Most importantly, this is what this looks like on the chart, where as we're getting fewer 1% losses and fewer 1% gains as well, that's when the market has then continued to trend higher. The rate of change has slowed down, of course, from the craziness at the beginning stages of April and May, but this is exactly how things played out before, where we see not a lot of 1% gains. It leads to consistent uptrends. So it's been a historic rally. Bullish patterns are working, and it's been supported by trends, by low two-way volatility and MACD sell signals and the like failing. But we've seen this action before, and we talk about all of this in this next video here. Check it out.